The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The S&P 500 extends for a sixth straight day as economic data and corporate earnings loom. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex Steele. 7 straight days.
Yeah, I thought it was 6.
A rally. 6. Yes,
Oh.
6. Up 7.5%.
I said 6, right?
I meant
and
6. You said 6. I said 7. I was wrong. It's the allergies. What can I say? So the S&P is up 0.6%. Okay, not that much to write home about, but you take a look at that 6th straight up day, and we're overall up about 7.5%. Just in the last 6 days alone. Haven't seen that since March of 2022. NASDAQ is in line, not outperforming, but definitely in line with tech earnings coming out. The VIX coming down, and the 10-year also a bit lower, Romaine. But if we hover between the 4.14, 4.1, that's the level that many analysts are looking for the 10-year yield to hold.
A lot of technical levels in play right now in fixed income and in the equity market as well. JP Morgan's trading desk is bullish on the market. Tactically speaking, they actually say that the de-escalation of trade war rhetoric can push the rally further. However, their call is purely on technical readings of the market rather than corporate and economic fundamentals. In fact, they say upside momentum likely to fade once the fundamental impact of tariffs becomes less theoretical and more reality. As far as that reality, it is starting to arrive. Fresh data this morning did show that the U.S. merchandise trade deficit widened to a record last month, while you had a separate report from the Conference Board showing expectations for business conditions worsening to the highest since 2009. Hilton and Kraft among companies today to actually lower their earnings guidance because of the uncertainty. GM and JetBlue withdrawing their forecasts altogether, and this all coming ahead of tomorrow's GDP report, the first full look at first quarter economic activity, where all but 3 weeks of the period were under the tutelage of the new administration.
The policy actions to date have raised the level of uncertainty to a degree that I don't think is healthy for investment and growth. As I'm talking to CEOs, as I'm talking to our clients, they are holding back on investment, and they're certainly tightening their belt. You're going to see some companies laying off, employees and running their businesses tighter because of this level of uncertainty.
And so here on this Tuesday, April 29th, the 99th day of the Trump presidency, an extension of the S&P's rebound rally is running into some degree of investor caution. Susquehanna and TD Securities urging folks to use options to hedge their portfolios just in case the rally stalls and stocks retest those near bear market lows, which actually occurred 3 weeks ago today.
Man, a lot has happened in those 3 weeks. All right, and those puts are actually a lot cheaper right now. So piggybacking off of what Romaine was saying in terms of JP Morgan Market Intelligence, talking about the rally's been driven by maybe short covering and not necessarily fundamental buying. This is one way to look at it. This is the S&P Advanced Decliners, and the spread between the top and bottom sector right now is the smallest of the year, taking into account today, but also yesterday. So what that really tells us is there's not that much conviction necessarily in the buying. There's been tons of report out that this is actually just short covering potentially. Hedge funds, for example, still shorting U.S. stocks. So on a rally, they got to cover. So it's all about that short covering momentum. And the most crowded shorts, get this one, Romaine, Microsoft, Google, and Amazon. And that's according to Citi, which sets us up for very interesting earnings over the next couple days. When we get earnings from those names, if they do well, do we see an easy pop in the overall index?
Yeah, that's going to be a big determinant of where this market goes next as we kick you off to the close here on this Tuesday afternoon. Katy Kaminski, Chief Research Strategist and Portfolio Manager at Alphasimplex Group, joins us now. And Katy, we were taking a look at the charts. We've seen a pretty decent rally off of those early April lows. However, there's a lot of questions right now about whether that momentum is indeed pointing to the upside. What do you see?
So interestingly enough, even though we've had a big streak, technical signals on longer term horizons are still short net in the US. So we're also seeing very muted views for those signals across all global equities. So this suggests that what we've seen more recently is more of a respite rally. So we really need to see more continuation, and we need to actually see fundamental data create a trend that is a new trend, not a recovery from what was a very large downward move.
And so, but as we sort of look at the technicals and then, of course, try to assess the fundamentals, which are now starting to come through with corporate earnings, big GDP report tomorrow, and, of course, later in the week, we get another read on monthly employment. What matters most to investors right now?
I think that investors need clarity. They need to see that they know that this uncertainty is going to be reduced. And I think just seeing that you're seeing companies postponing guidance, the fact that, it's hard to estimate where things are going. Once investors feel like they can grab something that tells them how much they need to input into all of their models in terms of the impact of these tariffs, I think then things will calm down. It definitely still has felt a little bit more like a respite, that there is some sort of potential put. There is some chance for de-escalation, which has given investors some relief. But my main point is we're not in a new trend, not yet, although we've had some respite.
Is it possible for tech to provide a catalyst when we start reporting earnings here?
That's definitely possible in the sense that you're going to see earnings that are going to give some faith back to investors. But I think the biggest challenge, even with earnings, is that people are worried about forward earnings. They're thinking about guidance. They're thinking about, how do we estimate the impact of this tariff into future earnings? So I think that's where that could help. But I think the whole picture is really uncertainty and reducing that uncertainty.
Right. So then how do you do that? Like, where's the safe haven? David Solomon said today to Bloomberg that treasuries, for example, are still a safe haven. The price still might change, but they're still a safe haven.
I would agree. I mean, we are seeing long signals in treasuries, but to be honest, this month made me pause. Why? Because this U.S. vulnerability trade is something that is still making a lot of people nervous. The fact that equities went down and bonds went down too is something that is making people concerned. And I think the biggest trends we are following is really the fact that, the dollar continues to be weaker. And we're going to have to keep watching treasuries as this narrative unfolds.
There's been a lot of talk, Katy, about sort of a perceived put in this market coming out of the White House, or maybe, to be more precise, coming out of the Treasury Department next door. Do you believe that?
Well, I think the market has sensed that there could be a put more recently, and that's why you're seeing such a strong rally more recently, is they're thinking, there isn't an ending point for where this administration might be pushed. Hence, we might see some backtracking, some adjusting, so that our worst expectations could actually be abated and that we might see some give and take. And that's why you're seeing some optimism and some continued buying, because those investors are thinking, there is a bottom to this, or there could be some level of put where, they're not going to let the markets fall as far as people initially thought.
I am curious. I was having a debate with someone earlier today about how accurate the pricing in the market is right now in terms of a reflection on how the broader investment community really feels. And Howard Lutnick was on a competing network earlier today, kind of calling it all noise, meaning the sell-off and some of the ructions in the market. When you look at the price action in equities, in commodities, and of course in fixed income and FX, do you think we're getting an accurate picture of where things stand?
Well, I always like to look at the technical signals and try and distill the noise from, the direction. And frankly, right now for bonds and stocks, there is very little direction. And that would be my starting point. And what I mean by that is, as the market is trying to distill the impact of such a large change in policy, I think there's just too much uncertainty around too many different things, and they need more data to come out to represent how much this is actually impacted. So the real hard data has to come out for us to know. Hence, I'm still in the view that, we don't know yet.
And even with the hard data, right? Like GDP tomorrow could come in poorly, but then we could see a rebound not too long out. So even that feels really volatile. Do you think, Katy, that trade nationalism will lead to capital nationalism, and how you have to rejigger maybe how you position your portfolios from that perspective?
I mean, we've seen some indication of that just looking at the Treasury market. I think people are thinking about the Treasury market differently, just given, the idea that it's not just U.S. investors holding U.S. Treasuries, and the fact that the U.S. dollar is going to be moving quite a bit as well. And I think in general, the biggest concern that I see amongst investors is so much of this safe haven for U.S. Treasuries. If that changes, it changes a lot for a lot of investors' portfolios. And hence, we're going to have to really think about that, especially as policy impacts Treasuries more going forward.
All right. Katy Kaminski, Chief Research Strategist and Portfolio Manager at Alphasimplex Group, as we keep an eye on stocks right around fresh session highs here on the session as we await some big announcements later tonight from the President of the United States. When we come back, we're going to take a closer look at drug maker Pfizer. as warnings about the impact of tariffs on corporate bottom lines ramp up.
And from the Trump presidency's trade policies to its policies within the FDA, we're going to sit down with Robert Califf, an instructor in medicine at Duke University and former FDA commissioner.
And a conversation ahead with the famed economist Mariana Mazzucato on the global economic implications of a Trump presidency as it approaches its 100th day. All that and more coming up in just a bit. This is The Close on Bloomberg.
All right, one stock we're watching right now is Hims and Hers. The stock is up 25%. The telehealth provider announcing it would provide access to Novo Nordisk's popular weight loss drug Wegovy for a steeply reduced price. Now both Novo and Lilly are pairing up with several telehealth platforms, which they once saw as the competition to offer their GLP-1s at a lower price. Did you follow that frenemy story? Well, Bloomberg News at Madison Muller did. She joins us for today's Stock of the Hour. This was a surprise in some ways, right? Because weren't they potentially definitely enemies, right? What led to this?
They were enemies because Hims was offering these cheaper compounded versions that we saw become really popular on telehealth sites like Hims and Hers and Rose and LifeMD during shortages of the real medications. And Novo and Lilly did a lot of public awareness, and they've filed lawsuits against various companies, not Hims, but they've really shown and come out against the use of compounded drugs. So for them to then go ahead and pair up with one of these companies to distribute their lower cost drugs on their platform was a little bit of a surprise. However, it comes as the end of compounding is upon us. And, at the end of this month, because the shortages are now resolved, compounding pharmacies are not supposed to mass produce copies of these drugs anymore. And so Novo said that they were talking to telehealth companies about the end of this shortage, what that means for patients, potentially leaving hundreds of thousands of patients without these medications. And they thought it was, the right time to pair up with a company like this.
What does the pricing look like relative to effectively the generic versions of this?
Yeah, so the prices for compounded drugs are sort of similar actually to what Novo Nordisk and Lilly have lowered the price of their drugs to be. So last month, Novo launched NovoCare Pharmacy, which is like a direct-to-consumer pharmacy. Lilly has Lilly Direct, similar idea, and they offer drugs that are about half the U.S. list price of these medications, which, remember, patients for the most part aren't paying the list price of medications because of things like insurance coverage and rebates and all of that. So this brings the price of Novo's drug down to around $500 a month. The U.S. list price is over $1,300 a month typically. And that lines up more with what we were seeing for some of these compounded offerings.
I guess I don't really get it, because it feels like Hims and Hers was the one to lose stuff. So why would Wegovy and Eli Lilly team up with telehealth providers to provide cheaper drugs when if the supply chain issue is resolved, they should be able to get as much as they want for their drugs, right?
Right, and I mean, that's what you would think, but I think that both of the companies have really pushed to expand access. And at the end of the day, this does help drive sales. I mean, I don't know what the most recent numbers were, but Lilly said, I think during earnings last quarter, that about 10% of patient new starts were coming from this cheaper option that they had rolled out. So we were seeing more patients start to utilize these options because a lot of insurance providers at this point still don't cover the drugs. So this sort of gets more people onto the drugs in the meantime.
I am curious if you've heard any sort of discussion about having a little bit more consolidation in this space with regards to how these things are distributed, because it's kind of all over the place, right?
Yeah.
And you mentioned Novo's direct-to-consumer pharmacy and the other one as well. It's almost like if you have that, can't they just funnel their customers or potential customers there rather than using these third-party middlemen effectively?
Yeah, and that is actually kind of what Lilly's doing. Lilly their models are a little bit different. Novo has NovoCare Pharmacy. Lilly has Lilly Direct, which is a platform that patients can actually go to, and then you're sort of they're partnered with other telehealth companies from that platform. So there is a little bit of, I can see what you're saying about it kind of being all over the place. But I think at this point, both the drug makers see the enormous popularity of telehealth and how it really boomed during the pandemic. And then there was a second wave with GLP-1s. And they're seeing that patients want to use telehealth. It's so much easier for them to go to a doctor online and then get the medication shipped to their house. And so they're trying to meet patients where they're at with that. And that's why they're doing some of these integrations with their own pharmacies and things like that.
All right. Well, it's fascinating kind of a shift, though, also in the market. And I think the last point is really valid, particularly if you don't need a doctor actually to physically touch you or anything like that. Then why go through that process? Madison Muller, who's been covering this better than anyone else, big pop today in HIMSS, up more than 20%. Novo getting a modest bid, up about 4% here with its U.S. ADRs. Meanwhile, when we come back, we're going to take a deeper dive into the world of tariffs and the economic fallout. General Motors reported earnings. Their shares down after pulling their earnings guidance for 2025 and freezing their share buybacks. A big question right now as to what comes next. A conversation up ahead with RBC Capital Markets global autos analyst when we come back after the break. This is The Close on Bloomberg. Let's get right to it. Top calls, big movers on the back of analyst recommendations. And we start off today with Amazon. Raymond James downgrading the tech giant to outperform ahead of its earnings report on Thursday. The analyst also slashing the price target from $275 down to $195, one of the lowest on the street, all because of concern about tariffs. Making matters worse today was, well, White House condemnation of the e-commerce company over rumors that Amazon planned to show consumers the cost of President Trump's tariffs on its platforms. The shares down fractionally, though, down for a second straight day, and we should point out, down about 17% over the last 99 days. Up next, ConocoPhillips, Bank of America lowering its recommendation on the oil and gas producer to neutral from buy, cutting the price target to 107. The analyst says Conoco is on the front lines of two economic wars, one on trade and the other when it comes to crude oil prices. Those shares down about 0.8% and down about 13% since Inauguration Day back in mid-January. And last up, let's take a look at Netflix. This is an interesting one. The streaming giant getting an upgrade to strong buy at CFRA. The price target going up to more than $1,200 after reporting record profit for the first quarter. Now, the analyst says Netflix has a, quote, unique competitive position that is unlikely to be affected by geopolitical risk or tariffs. Those shares up 0.8% on the day. It's on an 8-day win streak. It's up 31% since inauguration. In fact, it's the fifth best performing stock on the S&P 500 over the last 100 days. Those are some of our top calls here on the day. If Netflix is the port in the storm, I'm not quite sure what GM is. Those shares had plummeted about 11% in the 4 days following the April 2nd Liberation Day announcement by Donald Trump. The shares have regained some of their mojo since then, but now under pressure today after withdrawing its 2025 guidance and pausing its share buybacks due to the tariff uncertainty. Joining us right now to talk a little bit more about what the future holds for the company is Tom Narayan. He's RBC Capital Markets lead equity analyst of global autos, and he has an outperform rating on the stock. All right, Tom, I want to start off first with the forecast that now doesn't exist. I want to start off here with the share buybacks that are on pause, as well as a conference call that was inexplicably pushed back roughly 48 hours. Do you have any insight into why GM did that?
Yeah, absolutely. I think we saw it just maybe a couple hours ago with the Trump administration essentially certifying what we've been hearing in the press, which is some relief actually on auto tariffs and some clarity on that. I think GM was expecting something like that to hit potentially today, and they were supposed to release results this morning. So instead of including some guidance that may change dramatically just later in the day, I think they took the cautionary route of saying, let's wait till we hear what this announcement is, get some clarity, and then just issue the guidance a couple of days later. So I actually don't think it's anything to be overly worked up over. It just makes perfect sense. They had planned this call a long time ago to be happen this morning, and because of the nature of the tariff news, they just had to change the announcement.
Well, I am curious, given the way the stock has been battered around, pretty volatile over the last a few weeks because of concerns about what those automotive industry tariffs would look like. Are you optimistic now that some of those worst case scenarios and even kind of some of those middling scenarios might actually be off the table?
Yeah, it would appear that the worst case scenario is off the table. Certainly the stock has run up since the kind of worst case situation. As what we heard today, there'll be some relief for automakers actually having finished cars made in the U.S. For GM, that's 60% of their U.S. sales are made in the U.S. So even though there may be foreign auto parts, those will largely be exempt given the nature of how this is stipulated. So worst case scenario seems off the table, but still they do import some cars from Mexico, notably in Canada. I think like about 40% of their cars that go to the U.S. Those they'll have to figure out how to onshore some, maybe increase shifts in the U.S., but there's ultimately will be some tariff that they will have to pay. It just won't be nearly as bad as maybe some folks were fearing.
It looks like from Bloomberg reporting that base tariff, 25% tariff on auto part imports, there would be some kind of offset that you could claim anywhere from about 3 to 4%, and then that would decrease over time to still build in that incentive. Is the stock reflecting that potential upside, and I put that in quotes, or is it still getting beaten down on all of this news?
Yeah, it's kind of a messy day, right? You have a withdrawn guidance, the share buyback announcement. I don't know if folks have fully digested what this means because, that level of an offset is not a small number. And I believe that's off the sticker price, right? The tariff is only on the cost of goods sold on the non-U.S. content. So it's actually a substantial relief there. It would appear perhaps that the market still needs to digest that news. I also think people just want to hear from them, which we will hear on Thursday morning, what the new guidance is. Obviously, if they intend to offshore more, that could come at a cost. So I think people are just waiting for more details.
Tom, aside from this, how are sales actually doing?
I mean, it's kind of tough to say because they've been very strong. Right, but some of that is potentially some pre-buy ahead of the tariffs, right? So March was very strong. April, the signaling is pretty strong. So the thinking was like, are we seeing some pull forward of demand? There clearly is demand for cars. Obviously, if pricing goes very high, that could change things. But so far, demand seems healthy. U.S. consumer seems healthy. Obviously, if we get tariffs that cause pricing to increase, that may change the demand dynamic.
All right, Tom, super appreciate it. Thanks a lot, Tom. Narayan, lead equity analyst at Global Autos at RBC Capital Markets. And Romain, we should get maybe some more clarity later on today as President Trump will be holding a rally in Detroit.
Yeah, and it's kind of interesting that he would pick that particular place here. Obviously, he's going to Macomb County, a place that overwhelmingly voted for him in the most recent election. But of course, it is also the belly of an automotive industry that's been under fire.
Right, and one of the first lines that will get hit due to any of these tariffs. All right, coming up, another area of the administration that is getting hit, and that's the FDA. Robert Califf is instructor in medicine at Duke University and former FDA commissioner. We're going to talk about the state of drug R&D. This is The Close on Bloomberg.
.30 p.m. here in New York. This is the countdown to the close. I'm Romain Bostic.
And I'm Alex Steele. Looking at a market here that's still around the highs of the session, but doesn't feel like there's a lot of conviction necessarily behind it.
Yeah, it's kind of like a low energy rally, if you will, but it is 6 straight days of rallying.
Well, that's the thing.
Alex Steele.
Yes, I know 6. I said 7 before.
Yeah.
If you have consistently rallied for 6 straight days, eventually does momentum beget momentum, and then we see something a little bit more powerful, even though fundamentally maybe nothing's truly changed.
Well, and that's what we've heard from a lot of strategists that are concerned here, that, look, there's room to go in this, but there is kind of maybe a ceiling to this, unless, Alex Steele, we do get a little bit more clarity on the economic front. And, of course, that would, of course, mean more clarity on the Washington policy front.
Right, and the policy plus jobs and what that means will be front and center when it comes to Friday as well. Also, let's take a look at one of the areas of government, Romain, and that is the FDA. Targeted about 3,500 employees to be hit with a layoff, and then they had to wind up hiring back people because they didn't have enough people to do certain jobs. Yeah, and this was something that RFK, the head of Health and Human Services, was asked about at a hearing, and he kind of admitted that, look, if we get 80% of it right and then 20% of the people that were fired shouldn't have been fired, we'll just try to get them back. Unfortunately, as a lot of folks smarter than us has pointed out, that doesn't necessarily mean you're going to get those people back. Yeah. And more importantly, does that create some sort of longer-term brain drain? Well, particularly when it comes to food safety, for example, the FDA. All right, joining us now is Robert Califf, instructor in medicine at Duke University and former FDA commissioner. Doctor, it's really good to get your perspective. Thank you very much. Let's go to that brain drain. What is the reality of that in the FDA based on all the news?
Well, I mean, you've been over it. 3,500 people fired in one day, but that doesn't count the people that had already been fired, probationary employees and people that had DEI in their job descriptions. A number of others are looking for jobs. There's a process by which if you're looking for a job, you obviously can't make decisions about a drug, for example, for a company with which you're interviewing. So that's going to be an even larger number of people. So this is going to be a big challenge, just getting the basic work done. You know, the public hears a lot about controversial decisions, but 95% of what the FDA does is routine work to help people, for example, have safe food, develop drugs that are effective, make good devices, and control tobacco. That just takes people. So it's really going to be something that needs to be watched to see if recovery can be made from this.
In the meantime, in the meantime, where do you think the biggest holes will be, where the biggest struggle points will be?
Well, I think the effort was made, as I understand it, to not fire people who were reviewers of products or who did inspections. But what I think was forgotten in that is that there's an army of people needed. For example, if you're going to do an inspection of a generic pharmaceutical plant in India, you need a lot of people who do the pre-work about the history of the plant, the history of the products made, the history of the company. Someone has to plan the travel and deal with visas and government issues between governments. There are a lot of people who need to do the administrative work, and many of them are now gone.
I'm also curious, Dr. Califf, about the quality of some of those people, because a lot has been said, not just about the number of people that have been let go, but just the expertise that they had, and that's not expertise that is necessarily easy to replace. And I just want to quote something from Peter Marks, who basically kind of ran the FDA division for vaccines and gene therapies and other crucial drugs. He left at the end of March, and he said in his resignation letter that RFK, the HHS secretary, wanted, quote, subservient confirmation of his misinformation and lies. What does that mean to you?
Well, I left the FDA before RFK came, so I've never worked with him. But from what I understand from Dr. Marks and other people at FDA, RFK has a tendency to think he knows the answer and then look for people to do the work to support the answer rather than asking the scientific question and letting the data decide what the answer should be. So I hope that the new commissioner, Dr. McCary, can insert himself into this. He is a surgeon from Johns Hopkins, and perhaps, this can be retrieved at this point. Mm-hmm. But certainly I'd have to say, having run the FDA twice now, the things that are being said about vaccines are just very concerning. And the projections, I'm out at Stanford at a meeting right now, the projections from Stanford of the number of infections that we're going to see from things that were really part of our history and we didn't think we'd ever see again. It's really astounding and very concerning.
And I am also curious too, Doctor. We talk about these cuts and the relationship with Doge, and we focus on the actual number of people lost. But there's also this big issue right now of funding that has either been pulled or at least threatened to be pulled from a lot of research programs at universities. You helped to found probably one of the biggest research programs out there over at Duke. I am curious as to what the loss of federal funding, or even the threat of the loss of federal funding, would do to some of those university and private research projects.
Well, as I say, I'm at Stanford right now, which is one of the biggest research universities, and a lot of concern. This is a meeting about drug discovery, so we have, I'm interviewing 3 Nobel Prize winners this afternoon about this, and I think everyone's concerned that the infrastructure that has made the U.S. #1 in science and led to so many cures is being taken away. So we're all worried about it. We got to keep the pressure on to make sure that we don't totally lose the infrastructure, and a lot of concern about the health of the population. Let me just add, one point that's been made is we haven't paid enough attention to prevention. That's something this new administration is focused on, and I completely agree. So it's an area where we do need to double our effort, but it doesn't mean we should take away from finding a treatment for cancer or other serious diseases.
Yeah, and we should point out that RFK has certainly made that a big priority. The idea that, in his view, a lot of what ails us as a population could be addressed more through preventative medicine rather than post. I am curious here for the last question here, Dr. Califf, about this general idea of what the drug companies themselves are doing. In between your stints in the FDA under the Biden administration and previously under the Obama administration, you have spent time advising drug companies on how to navigate the regulatory process, how to navigate the FDA. What are you hearing from them now? Are they concerned that they may have trouble getting things approved or even just getting the attention of regulators?
Well, one slight modification I make, I spent my career in academia doing clinical trials to develop treatments and evaluate them. So I wasn't really advising companies on how to navigate the FDA, but we are hearing at this meeting that several companies have had their applications delayed. They can't find the right person to talk with because many of these firings happen without giving people a chance to hand off their work. Now, again, I hope this can be remedied soon, but we're certainly hearing from the companies out here. And for patients, for example, with rare disease who are waiting on a treatment, this could be life or death.
All right, Doctor, we're going to let you get back to your conference. Dr. Robert Califf there, he's an instructor in medicine over at Duke University, and he was FDA commissioner in 2 different stints under the Biden and the Obama administrations. We'll be back in a moment. This is Bloomberg. All right, welcome back. We're taking a look at shares of Pfizer, getting a modest bid on the day, actually a stronger bid now, up about 4% here on the day. This after the company did report first quarter revenue that actually missed estimates. However, the CEO says they're looking to remedy that, looking to make 2 to 3 deals this year as they look to bolster their drug pipeline following the failure of its obesity pill. Joining us right now is Vamil Divan. He's global biopharmaceuticals and biotechnology analyst at Guggenheim. He's got a buy rating on the stock. Interesting comments out of Pfizer today. I thought the key word there was prudence that we heard from Albert Bourla there. Talk a little bit about why you think the market is actually embracing these comments.
Yeah, I think there's a few things. As you mentioned, the sales were actually a little light for the quarter. The bottom line did beat due to some cost savings they're doing. And then they implemented another $1.2 billion cost savings going forward, just giving some comfort to investors on the sort of earnings trajectory over the next year or so. And then he made a couple other comments I thought were very interesting. One was around the dividend, which they previously have definitely supported. And so they're going to keep part of the story, maintaining, growing the dividend, but reinforce that today, even in the face of maybe doing some deals, in the face of potential tariffs, the dividend is still secure. I think that was very comforting for investors. And then some of his broader comments I thought were interesting around tariffs and some of the concerns investors have around reference pricing, where U.S. drug pricing might be tied to ex-U.S. pricing. It doesn't sound like, from what he sees at least in his discussions with the Trump administration, that those are big threats to Pfizer or to the peers. So I think it helped Pfizer and sort of helped the group itself to do a little bit better than we thought today.
Hey, Vamil, how aggressive do they have to be in their deals and what their pipeline is, their growth pipeline without that obesity drug? So how aggressive should they be?
Yeah, so they're in a little bit of a tough spot. We do like some of what they have in their own internal pipeline, and that sort of drives our buy rating. But they are losing a number of their current products to patent expiries over the next few years, and then some other products that are facing just competition and other challenges. So it's about a $17-18 billion hole that they have to fill just to overcome the declines that we're expecting from those products that are going away. So that's sort of the minimum they need to do. They have done deals like Seagen and some of these other ones that have helped fill the gap a little bit. But there's still probably another 5-10 billion of sales that they need to add on to really get people comfortable that there is some growth. It's not just a matter of keeping sales flat for the next 5 years, but there's actually potentially some growth as we get to the second half of the decade. So I think that's what people are looking for. But on the other hand, they are somewhat constrained because of the dividend, because of just their capital position right now. So that's where I think there's that balance. They don't want to overextend, but do need to do a little bit more to get people comfortable with the long term.
Well, I am curious when we talk about the potential for deals, Vamil, I assume they're going to have to be very pointed in terms of picking a company and ideally whatever drug or drug development that company has that actually does potentially provide some long-term benefits. Did they articulate what areas they might be looking at?
Yeah, so obesity is definitely one of them. They had the failure from the internal pipeline, have some stuff internally still going, but obviously huge market, big driver for a lot of their peers like Lilly and Novo, and I think they want to get a part of that. So that's certainly one. I think immunology and Inflammation is another area that they've talked a lot about. They have some products there, have a little bit of a strong legacy business there too, but not the big long-term growth drivers in that side. So I think that's the other one. Then the other two areas where they do have a big presence is oncology as well as vaccines. There, I think right now, at least they feel pretty good about what they have. So obesity and then immunology are the two areas where we'd expect them to make some deals here over the next year, couple of years.
All right, Vamil, thanks a lot. Vamil Divan joining us, global pharmaceutical and biotechnology analyst over at Guggenheim. That stock up 3.8%. All right, we're about 15 minutes away from the close of trading on this Tuesday. Now you're looking at six straight days of gains for the S&P. S&P is up about 0.5 of 1%. Yeah. No, you told me. That's why I know it's real. But again, volume light. You are seeing a little bit higher volume when it comes to trading the NASDAQ. But for the S&P and the Dow, it's lighter volume. Yeah, and it's kind of interesting. I think a lot of investors are waiting to see some of that economic data this week, waiting to hear from the president tonight. We've already gotten a lot of reports that maybe there might be a reprieve for automakers, maybe something else. Yep, and is that going to be enough to wind up lifting the equity market? Jay Woods, Chief Global Strategist at Freedom Capital Markets, will be joining us to walk us into the close. This is Bloomberg.
You're going to see earnings that are going to give some faith back to investors. But I think the biggest challenge, even with earnings, is that people are worried about forward earnings. They're thinking about guidance. They're thinking about, how do we estimate the impact of this tariff into future earnings? So I think that's where that could help. But I think the whole picture is really uncertainty and reducing that uncertainty.
Katy Kaminski joined us just about 50 minutes ago to kick us off to the close, a focus on the technicals in this market as investors now turn their attention a little bit more to fundamentals. Fundamentals, of course, that are still tied, Alex Steele, to the policies coming out of Washington. Yeah, let's get to that because you wind up having a rapid response X account. So that's the 24/7 White House Twitter feed, basically, saying that President Trump is signing an order on overlapping tariffs on cars. It provides a text of Trump's order on tariffs on X through rapid response. So we'll get more details as that comes, but it looks like he is ordering an overlapping tariff on cars, so we won't have too many tariffs. And you have to see around the highs of the session. Still for the S&P, actually the highs up 0.7%. And just a quick look at some of the auto stocks. Not a whole lot of movement on that headline, but we'll give it a few more times to sort of trickle its way through down to those making those decisions as we continue to count you down to the close with just about 8 minutes until we get there. 6 straight days of gains here, a rally that some say is less fundamental and more technical. Let's see what our next guest has to say. Jay Woods, Chief Global Strategist at Freedom Capital Markets, joins us today in Studio 2. All right, normally I wouldn't poo-poo a 6-day rally, and and we should point out the first couple days of the rally were monster. I know the last couple days have been a little weaker here, but when you look at the technicals right now, do you get any sense that there is extra momentum, if you will, left in the tank, that we can maybe start thinking about 7, 8, I don't want to jinx it, 9-day rally?
You killed it right there.
I'm happy with 6, and if you went away at the end of March and you're coming back, April's flat. What happened? But what we saw was an exhaustion. This market just finally puked out that sell side. The VIX spiked to 60. We had 20% corrections in 65% of the individual names in the S&P 500. It wasn't technically a bear market, but we lived through it. It was, that was a bear market, and we're getting a relief rally. The relief rally is now starting to tire. Yes, 6 days in a row. We could go 7, 8, 9, but volumes are slowing down. The VIX is finally stabilizing. The news out of Washington isn't coming at us every single second, although we just got breaking news as I come on the air. So we've got now to focus on some fundamentals, the earnings. We broke above the 20-day moving average. Traders like that. They use that. We haven't been above it in quite some time. Now we watch the 50, the 200-day, and see if we can tread water for a little while.
What are the earnings telling you so far? I know we're still relatively early in the season. Most of the earnings haven't been awful. I mean, there have been a few that were kind of like, okay. But, I mean, if you were to sort of aggregate it all, it looks like the backwards-looking numbers for more or less held up. And even some of the forward guidance, at least those companies that were willing to give it, were still relatively in line with what the street, maybe, a few pennies off the mark, but nothing really dour.
Yeah, the bar was lowered a little bit, but we're clearing that bar. The guidance, that's where we're not getting excited because they can't give it. It's still murky. I mean, Apple hasn't given guidance in quite some time, but we don't expect rave reviews going forward. But if we continue to do well, and inflationary data, by the way, has not run away from us. We're concerned about what these tariffs may bring us, and we should be concerned about it. But right now, the data has been pretty good. The earnings are solid, but we're not getting that warm feeling like, all right, it's smooth sailing ahead, because we know this uncertainty, the word of the year, is here for a little while longer. And once we get some clarity, we're getting it a little bit from some of these earnings, but we're not all clear right now.
So would you say that the rally that we've seen is that short covering or some fundamental buying?
I think it's a little of both. I think, we had the washout, you get the relief rally, now you digest it. That V bottom during COVID, a lot of people are comparing this to 2020, how quickly we washed out, a different scenario, and then 2022 when we went into a full-blown bear market. That V bottom during COVID still took 2 months to recover back to the 200-day moving average. We still have a ways to go to 57.46, but we're a month back. The rally has been pretty good. Now we just get through the next few data points, next few earnings, and then I think we'll be all right. But we have some water to tread, some wood to chop, as you say, and we'll get back.
What do you think the stomach is of traders to buy the upside of good news? So when the White House says that the order that President Trump just signed is tackling the cumulative effect of overlapping duties on cars, that would imply that he's going to kind of pare back some of those tariffs in some way, right?
Yeah.
Or cancel some of them out so that car makers don't get hit as much. We're on the highs of the session, but we're only up 0.7%.
Yeah, and we're now just about even for April, as I said earlier. A lot of this is algo-driven. When you get news and constant tweets, people are reacting to those buzzwords. Okay, tariffs are lower. We're negotiating with this country. So it is still a quick knee-jerk reaction to things, and then we settle down. What we're seeing now is that settling across all indices, but Mag 7, that's where the focus needs to be, and we're going to get that over the next couple of days with Meta, Microsoft, Apple, and Amazon. And then, of course, the big one, NVIDIA, which is watching these four very closely, because that CapEx spending, that AI spend, guess who's going to benefit from it? NVIDIA. So NVIDIA kind of led them on the way down, and now I think if we're going to come back, if there's one stock, and I hate to say, oh, this one stock's the most important stock in the world, but NVIDIA is the one to watch if that can get back in a couple weeks. So these four set us up for hopefully a recovery in the leadership of this market. But right now, the reason we're down as much as we were, those magnificent names, and if we're going to get back on track, they have to come back, because the top 10 stocks make up about 38% of the S&P 500 now.
I am curious as to how just the economy factors into this. And I know you're not an economist, and we still have not seen real hard economic evidence of the damage or the potential damage from the tariffs that could come. And I do wonder if the market is already sort of pricing that in, or if we do get negative economic prints going forward, that would end up being a shock.
Well, we got a nice peek behind the curtain when you talk about pricing things in. On Liberation Day, we were rallying after the close because the Wall Street Journal reported that it was going to be 10% tariffs across the board. And I was on with Jess Menton of Bloomberg talking about this. We don't know what's going on. Okay, the Journal's reporting this. And then, no, we saw the reality of what it was, which shocked everybody, and we washed out. So everyone saw the worst case scenario. Now we're working our way back up from it. The hard data has been in line, so it's been okay. Those inflationary concerns, yes, it's sticky, but we're not seeing things rise. Doge hasn't had the impact people thought it would. Unemployment, 4.2%, still historically low. It's the soft data that has us concerned, but as a technician, you look at that soft data and you see consumer sentiment washed out at all-time lows. That's usually when we're closer to a bottom. And where do you see these numbers matching up?
Yeah.
To historical bottoms, whether it was during the financial crisis, 2011, or during COVID. The sentiment is as bad as it was then. So maybe the worst is baked in already.
All right, Jay, always a great conversation. Jay Woods, Chief Global Strategist at Freedom Capital Markets, counting us down to those closing bells. Just about 2 minutes until we get there. The market's staging a 6-day rally. Some consequential earnings after the bell, including from Mondelez, Starbucks, Booking, and Corvo. Full market coverage, that begins right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele, taking you through that closing bell. It's a global simulcast, and it starts now. Scarlett Fu in the TV studio, Tim Stenovic in the radio booth. Carol Masser has the day off. Emily Grafeo filling her shoes for the day as we welcome our audiences across all of our Bloomberg platforms. Tim Stenovic, 6 straight days of gains for the S&P 500. A pretty decent rally over those 6 days into what's about to be a fire hose of earnings over the next 3 days.
Yeah, the question is, do the earnings that we get over the next few days change the tune? Because we have seen a lot of buying, Emily, over the last 6 days. The S&P 500 up close to 8% just in that period of time.
Yeah, I mean, the word on the street, at least if you look at what JP Morgan's trading desk is saying, is that the near-term momentum is risk on. The direction of travel is up. No matter what happens later, at least for right now, there's green on the screen.
And it's also worth noting that at least for today, the indexes hit their intraday highs when there's some comments from Trump surrogates, Howard Lutnick, Stephen Miller, suggesting that deals are closer to getting done. And that's certainly helping to support sentiment, at least.
And at least we heard from the White House as well that an executive order that Trump signed tackles the cumulative effect of overlapping duty on cars, which goes to the point that Jay Woods was just making on air with us, that maybe that bottom is actually in. But now, what is that top that we need to be looking for?
Yeah, and that's the question, though, too, right? I mean, it's easy to sort of look at the big gains that this market has made just over the past few days and really the last few weeks here. But, of course, you have to remember the starting point of where we were at the beginning of this year, or at least at the beginning of this administration. Still a lot of room to go in order to claw some of that back. We should point out, over this 6-day stretch, you are looking at an S&P 500, but it's actually up 8%. That includes 8%. That includes a gain of 0.6% here on the day. It's going to close out right around 55.60. The NASDAQ composite up about 10% over that stretch, is up 95 points today, or 0.6%. The Dow Jones Industrial Average adding 300 points, or 0.8% here on the day. And the Russell 2000 getting in on the action with a gain of 0.6%.
All right, well, the gains pretty broad-based. 3 stocks higher for every 1 stock that was lower in the S&P 500. 370 to the upside, 133 remain to the downside.
All right, let's get to Qorvo, a maker of special components that go into smartphones and other devices. The company reporting revenue for its fiscal fourth quarter, adjusted revenue of $469.5 million. That does appear to be a beat. The street on average was looking for roughly $851 million. Adjusted EPS also a beat, $1.42. The street on average was looking for 99 cents a share. Not really seeing any guidance jump out at me at the moment here, but you are seeing a slight move in the shares higher, up 5% in the after hours trade.
All right, and let's also get a read on travel here from online booking company Booking, reporting first quarter revenue beating analyst estimates, $4.76 billion, higher than what was anticipated, which was just under $4.6 billion. Gross bookings also beating analyst estimates at $46.7 billion. First quarter room nights sold, 319 million, better than the expected 316.6 million. And first quarter adjusted EBITDA also topping the $1 billion mark, $1.09 billion. Analysts were looking for 849 million. So that stock right now marginally higher in after hours trading by about 0.25%.
All right, taking a look at Caesars Entertainment. So for the first quarter, they had a loss about 54 cents a share on net revenue for the first quarter, about $2.8 billion. Now, their same-store adjusted EBITDA came in stronger than estimated, and their same-store net revenue sales came in bang in line with estimates. Remember, they had a tough comp period because of the Super Bowl in Vegas last year. They do point out the 2025 free cash flow will show significant improvement.
Yeah, also going to be listening on that call for any commentary about what's going on in Las Vegas. We've seen some anecdotal reports of decline in visitors to Las Vegas. In the meantime, I'm watching First Solar and seeing what's going on with First Solar. First quarter adjusted earnings per share coming in way below estimates, $1.95. Estimates were for $2.48. The first quarter EPS missing estimates. The operating income coming in below estimates as well. First quarter net sales coming in shy of estimates. Shares down 6.66%, Emily.
All right, Tim, I'm looking at Trivago. The first quarter coming in at a loss per share. The first quarter revenue also looking just actually beat estimates here, 1.24.1 million euro versus estimates of 110.7. That's all we're getting from Trivago right now.
Kind of interesting, too. I mean, when we talk about the sort of consumer spending and you take a look at what we're learning out of Booking, what we're learning out of Caesars, and then you take a look at Trivago, and then you overlay that with what we learned earlier today out of Royal Caribbean, it's kind of interesting to see that this might not necessarily be the type of economy and the type of read on consumer spending that is going to be sort of cohesive and all as one. You're going to see layers and you're going to see pockets of that. And I think that's reflected in the numbers that we're getting here in the after hours trade.
And to that point, companies are really making a point of buying back their stock, also increasing their dividend or making sure that they stay current on their dividend as a way, because that's a way that they control the variables that are within their control, right? Because the macro environment is all kind of beyond them. But what you can do is manage your cash and return cash to shareholders. And the case of Booking, for instance, declaring a cash dividend of $9.60 a share, and also talking about their stock buyback program as well.
Let's go back to First Solar for a moment, guys, because that stock's down 14%. Their updated outlook reflects expected tariff impact. Remember, you have a tariff impact from solar imports. That's going to affect the guts and stuff of what we do to build solar panels. They look at their full year operating expense at the high end, about $510 million. Now, the CEO in the earnings release says that despite near-term challenges presented by this new tariff regime, they believe the long-term outlook for solar demand in the U.S., particularly in that core market, remains strong.
We also are getting some breaking news coming from the healthcare space. United Health names Patrick Conway, the CEO of Optum. United's Heather Cianfrocco is taking a new EVP. This is coming from an 8K that was just filed. I'm looking at shares of United Healthcare in the after hours right now, and they are unchanged in the after hours. But once again, United Health naming Patrick Conway as the chief executive of its Optum Group.
You know, I'm really looking at that booking number and just wondering how much of a read we can really get here on the macro environment, particularly because these results are backward looking. I mean, this is the first quarter. This is really coming before all of the headlines, and we could call it, uncertainty about tariffs here. We'll see how that weighs on the guidance.
Well, one company, of course, that could really be affected by this is Starbucks. So shares moving lower in the after hours trade. The earnings crossing the wire right now. The company saying that in its most recent quarter, the fiscal second quarter net revenue came in at $8.8 million. That's basically on the nose. The street was looking for $8.83 billion if we want to be precise about it. Comp sales overall did drop, down 1%. The street was expecting a drop of about 0.6%, so slightly worse than what the street was looking for. U.S. comp sales, that was decidedly worse, down 2% in the quarter. The street was looking for a drop of only about 0.25% on the quarter, so a big miss there. Adjusted EPS also missed, 41 cents a share. The street was looking for 49 cents a share. I'm still looking for some guidance here, but the company basically, for all of the major units that it has, certainly here on the U.S. side, it does appear to be a miss, including in North America. The one bright spot does actually appear to be international sales. Those comp sales actually rose unexpectedly 2%.
All right, let me jump in here with Mondelez, the packaged food company, seen as more defensive in these kind of uncertain times, reporting first quarter adjusted EPS of 74 cents. The overall headline number for EPS was 31 cents. Net revenue coming in just a little bit shy of analyst estimates. You could call it even. First quarter net revenue of $9.31 billion. And in terms of its outlook, it sees full year organic net revenue of about growth of 5%. Analysts were looking for just about 4.9%. So that's slightly better than what analysts had been anticipating. You're looking at the stock moving slightly higher right now, up about 1/3%.
Just want to hit quickly on Edison International. Operating revenue for the first quarter came in light, even though core EPS actually beat. The Eaton fire investigation is continuing. The company says it's working close with state and county leaders. We will have the CEO on tomorrow at 3:10, Pedro Pizarro, CEO of Edison International.
Well, Visa shares spiked, and then they've come back to earth a little bit in the after hours, just up about 0.5 percentage point. The company has authorized a new $30 billion share buyback program. In terms of numbers that the company reported, second quarter net revenue coming in above estimates at $9.59 billion. Second quarter adjusted EPS also a beat. Second quarter total Visa processed transactions coming in shy of estimates at $60.7 billion. The company declared a quarterly dividend of 59 cents a share. Once again, shares of Visa in the after hours higher by just about 0.1%.
And looking at Mondelez again, the outlook does not reflect potential tariff changes, the company said. It's a similar theme that we've been seeing a lot of companies say now, that they just, I guess, can't yet price in the impact of those tariffs.
And Seagate earnings crossing the wire right now. Of course, this is the hard disk drive maker. Shares higher by about 7% in the after hours trade after revenue in the most recent quarter jumped 31%. That was relatively in line with estimates, $2.16 billion. The street was looking for $2.13, and adjusted EPS also beating $1.90 a share. That's a huge jump from what we saw the previous quarter a year ago when they posted 33 cents a share. That $1.90 beats the average of street estimates of $1.73.
Okay, Caesars, Mondelez, First Solar, Visa, Edison, Starbucks, Snap we're still waiting on, but we certainly went around the world when it comes to today's report. A little warm up for what we have coming later this week with mega cap tech. That is going to do it for our cross-platform coverage of the market close. Emily and I are heading back to radio and YouTube. Alex is heading out. Scarlett and Romain are going to continue on TV. We'll be back tomorrow, same time, same place, right here on Bloomberg.
And we continue our coverage right here on Bloomberg Television. A lot of movers in the after-hours trade on the back of earnings. Some of the biggest gainers in the after-hours trade, Corvo, Western Digital, Caesars, as well as Seagate. But to the downside, you're seeing some big names there. First Solar, Booking Holdings, and Starbucks. Starbucks shares down about 2% right now in the after-hours trade on the heels of that earnings report. An earnings report that missed on several key metrics, particularly here in the U.S., as Brian Niccol tries to execute his turnaround plan. Abby Roach joins us right now, senior portfolio analyst at Allspring Global Investments. And Allie, we were expecting some softness there. We certainly saw it on the U.S. side. One thing that was surprising, you actually saw a little bit more strength in China and overseas. What did you make of the report?
Yeah, I was encouraged to see the better results from the international segment. I think in terms of what we were looking for in the print, we're certainly expecting a little bit of a weaker print from a comp perspective, and certainly saw that in terms of the U.S., but not significantly worse than we were expecting, but definitely encouraged by the solid international results. So encouraged to see that.
What exactly do you want to hear out of Brian Niccol later today in terms of articulating his long-term vision for Starbucks?
I think certainly we would like to hear an update on the different strategic initiatives that they've outlined. Some of the bigger things that we want to hear about, the focus on the 4-minute wait time for orders, any progress that they've made on that we think will be important. And then also just in terms of the order sequencing within the app, that's a pilot test that they talked about during the Q1 call, and that was in just 3 stores, but I think is something that's going to be very important for the future with the mobile ordering. So I'm curious to hear an update on that because I think it'll be really important, both of those metrics for improving throughput for Starbucks in the future.
I'm just going to jump in here really quickly because we also just got earnings out of Snap, the social media company that teenagers love. And here we have a company saying its daily active users were about 460 million, just slightly higher than the expected 459. And that top line revenue has grown, but headwinds began in the current quarter. First quarter revenue coming in at $1.36 billion, just slightly above the consensus estimate of $1.35 billion. And Snap has omitted formal guidance for this quarter because of the uncertain macro conditions. So again, top line revenue grew in the first quarter, but the headwinds began showing up in that period. And as a result, it has omitted formal second quarter guidance. The stock currently down about 2% in after hours trade. Abby, let me come back to you when it comes to Starbucks, because one thing about Brian Niccol, he's done a tremendous job at his previous employer, Chipotle, but he didn't necessarily have the international experience that leading Starbucks would require. Some of his initiatives to improve the customer experience at Starbucks in the U.S., including, you mentioned, reducing the wait time to under 4 minutes. Do those things translate well in a market like China?
We think it's important. Certainly, I think that's universal. The one thing with Brian, he's really been focused on the U.S. market and less so on the international. I think when he came out and spoke about a lot of his plans, he's really been focused on turning around the U.S. business. But I think a lot of the different initiatives that he's done will translate to China and the other international markets.
How are you thinking about the cost to put in some of those efficiencies? He's talked about store renovations because some of the stores were looking a little bit tired, at least here in the U.S. All those efficiency improvements. I mean, if you want to get wait times under 4 minutes, you're going to have to hire more people. You're going to have to bring back the condiment bars. How much are you comfortable seeing Starbucks spend on these improvements?
I think the one thing I'll say is I agree they're going to need to spend to make the improvements, but we heard even on the last quarterly earnings call a much more deliberate and just thoughtful way of thinking about costs. And just the example I'll give is when they talked about the siren technology, instead of those being rolled out to all of the stores, they're really focusing on that now on only the top quartile of stores, because those are the stores that really need that advanced technology. So I think in terms of certainly there's going to be incremental costs that are going to come out, but I've been encouraged thus far by Brian and the team taking a much more deliberate and thoughtful approach to costs, not just being across the board and necessarily in every store, but instead in the stores specifically that'll need to see those costs.
Headlines also crossing the wire here, Abby, on the idea that Starbucks, as you would expect, says that it is seeing challenges when it comes to tariffs, as well as obviously the volatility that we've been seeing really long before this president's administration in coffee prices, as well as other commodity prices that might actually affect the company. What options do they have to mitigate that?
Those are two of the key factors that we've been watching. I think one of the obvious ones will be in terms of pricing, but I think they'll continue to be very deliberate with pricing given the sensitivity there. We also saw them make some changes in the first quarter around eliminating the alternative dairy costs. So I think that's one way for them to do it, is just pricing across the board, but I think they'll be very strategic where they need to price that. And I also just think their scale gives them a natural advantage to be able to help both hedge some of the costs and be able to find more creative ways to offset them given their scale relative to some of their peers.
Yeah, can you talk a little bit more about that? Because we know that they usually hedge against rises in Arabica coffee prices, those beans, through futures. And they're not usually relying on Robusta beans. But is that an option for a company like Starbucks? Or do they still need to get back to basics first before they expand and get creative with their beans?
I think both will be important. I think really improving the customer experience is going to be paramount for them. And I think, that has clearly been one of the main areas that Brian has been focused on. But I also think the cost side of things is really important. And I think that they'll continue to be strategic in how they try to reduce some of those costs and how to be able to solve some of those problems. So I don't think it's an either or. I think that they'll be able to do both of those.
All right, lots of challenges for Brian Niccol, the CEO of Starbucks. And of course, we will bring you headlines when the earnings call begins. Abby, thank you so much for joining us. Abby Roach is Senior Portfolio Analyst at Allspring Global Investments, which does own shares in Starbucks. We've been talking a lot, of course, about the hospitality sector and the travel space. And we're not done here because Booking Holdings currently down about 4.25% right now in after-hours trading, while Caesars Entertainment climbing about 2%. Royal Caribbean reported earnings this morning. The cruise line operator has defied signs of any travel slowdown. And of course, when you look at another sector of the travel industry, the Hilton CEO says travelers are in wait-and-see mode. So it's a real mixed bag here, Romain, in terms of the different parts of the travel industry coming out and trying to give investors guidance on what they see.
And it was also interesting, too, because see the interesting reaction, particularly when it comes to Royal Caribbean, because there was some optimism right out of the gate, this idea that people were still cruising and things like that. But also people started to look a little bit further down and saw that trend line, that growth trend line, was actually starting to moderate, and you saw the shares moderate as we went back closer to the close.
All right, so let's bring in Lizzie Dove. She is Vice President at Goldman Sachs Global Investment Research. Lizzie, good to speak with you here. What did you gather from the outlook that Royal Caribbean gave? Romain just pointed out some of the nuances and what they see. And one thing that investors have really liked about the cruise line operators is that there is visibility, right? You have to book your cruise vacations months in advance, if not years in advance.
You hit on a great point there, because visibility really is the key. And it's something that differentiates cruise when you compare cruise versus airlines or hotels that you just mentioned. So, for example, for this year, 2025, Royal Caribbean is already 86% booked. It's really mostly booked for this year, which makes things a little bit more stable. But even outside of that, the go forward was pretty promising for Royal today. They said that even as recently as April, so this month, bookings are still up year on year and at higher prices. So pretty good sign for even 2026 as well.
Is this going to be a rising tide lifts all boats type of thing, Lizzie? Pun intended. What we see in Royal Caribbean, should we see that from Norwegian and all the others as well?
It's possible, although I do think there is some nuance. So I think generally cruise broadly as an industry is positioned very, very well. I think one thing that people forget is that cruise vacations are still at a 20 to 25% discount versus land-based vacations in a hotel. So that value that it offers to consumers, that is going to be a rising tide that benefits everybody. If you have a customer that's hard pressed for a little bit of cash, but still wants to take their vacation. Now, that being said, Royal is taking share. And so I don't think there's a 100% read-through tomorrow. We'll see with Norwegian. We're expecting a little bit more of a weaker read-through there on Norwegian tomorrow, maybe a little bit lowering of the guidance just because they have pointed out some weakness in some of their brands, particularly on luxury. But broadly speaking, we do think cruise can outperform broader travel at these levels.
Okay, so the advantage that these cruise operators have is that the bookings are made so far in advance. But does that mean that that's also a disadvantage because the pricing is done so far in advance? And if there are significant price increases, the companies can't really then adjust the price that customers have already booked, can they?
They can't. So in terms of the close-in, though, that's really where they can gain a lot of pricing power. And those last, filling that last 10% of occupancy is what can be the delta of a big beat or a big mix in any quarter. The other piece as well, I would say, and to not forget, is that onboard has become a really big piece of the puzzle for cruise lines. That's not just the casinos, the gaming, the food, the beverages, but also it's the private islands, which are a huge part. And that is real time. There's pricing algos for that, and that can be also a huge source of upside for these cruise lines.
Do you have a sense, though, Lizzie, that the amount of investment that these companies have to spend in order to sort of build out those things, and I know those are sort of ultra long-term investments, do you think that's still going to remain intact given some of the concerns about economic conditions?
I do. And I think, if anything, it's a really positive mix shift from a returns perspective. If you look at CocoCay, which is Royal Caribbean's private island, the returns on that are about 40%. That's compared to maybe mid-teens for the cruise ships. So you really get a lot of bang for your buck there. And in this environment where people are more value conscious, but they still want to take their vacation, something like a private island that feels very exclusive, but there's all these amenities, water parks, something for everybody, that really appeals. And if anything, it's those bookings that are getting more traction than just your standard cruise that doesn't visit one of these islands that they've been investing in.
All right. Well, it was a fascinating report here. Kind of weird to see the market reaction go from positive to, I guess, tepid, if you will. But, of course, that could course correct. Lizzie, we'll let you get back to it. Lizzie Dove, Vice President within Goldman Sachs' Global Investment Research Department. A closer look at the cruise lines as we do focus on consumer and travel. And that brings us to our next company, Shift for Payments. It's a consumer payments platform, not necessarily a household name, but if you're at a resort, if you're at a restaurant, or doing a lot of other things while you're traveling, chances are if you swiped your card, well, you've interacted with them in some way. That company raising its forecast for 2025 with the president and incoming CEO, Taylor Lauber, writing in a letter to shareholders that recent political commentary and capital markets volatility, that hasn't actually translated into reduced consumer spending. Pleased to say that Taylor Lauber joins us right now here in Studio 2. Great to have you.
Thanks for having me.
I thought that comment was interesting because, I mean, you kind of also hedged it by saying, look, you're still obviously preparing for the worst, if you will, as you would expect any CEO to do. But talk about why you don't think we could see any material slowdown in consumer spending.
I think there's two things to dimensionalize in these kind of earnings cycles where you're getting a lot of kind of economic rhetoric, but also, a mixed bag of reporting from a bunch of different companies coming out here. In our circumstance, we've seen consumer spending generally quite stable across the entirety of our merchant portfolio. So to keep in mind, we service about a third of the restaurants in the country, about 60% of the hotels, and then an overwhelming portion of the sports and entertainment venues. And inside of those locations, we've seen spending quite moderate. What I would say is this isn't euphoric. This is same-store sales at or slightly below or slightly above where they were a year ago. And that's simply just not a cause for, I think, overwhelming euphoria or alarm. It's just something to pay attention to. Now, I say this comes in two parts because keep in mind there are a lot of share gainers and share losers in markets like the ones we operate in. We posted revenue growth of 40% year over year. Really, it was between 35 and 40% across all of our KPIs, payment volume, revenue growth, adjusted EBITDA. So you have businesses that are able to perform really well simply by adding customers, and clearly the confidence coming from businesses like that is quite strong, despite trying to figure out what the consumer is going to do over the next year.
Well, how much do you have to sort of play economic forecaster, if you will?
So I think for us, what served us well is to simply not do it at all. Never account for your customers to grow for you. And if you don't count on your customers growing for you, you're forced to add a lot of customers if you want to deliver market-leading growth like we have. So I think times like now serve us really, really well, times of uncertainty. And I would say it's uncertainty is kind of the only way to describe it. Forces you to think about how am I going to add customers? How am I going to grow through a consumer that may be nervous about what the year ahead looks like?
And one of the ways you're doing that is by making acquisitions. You made some significant purchases recently, GiveX and Global Blue, among the others. What's the common thread tying these transactions together, and how does it support and add to your overall strategy?
It's a great question. So the common thread, whether it's GiveX or increasingly Global Blue, which is an acquisition we expect to close on in the next few months, is that the commerce value chain has gotten immensely complex. And whether the consumer realizes it or not, they're typically dealing with lots of different components when they engage with a world-class customer. And so we've had tremendous success buying a business that specializes in just one of those components and saying we can deliver that component plus a bunch of other things that the merchant's going to rely on. So when we did it in hospitality, it was combining a payment gateway that 2/3 of the hotels in the country were using and the payment processing capabilities that they were typically outsourcing. So GiveX is an extension of that, and gift and loyalty. These are world-class merchants that need this capability of great gift and loyalty capabilities all over the world. And now we can bundle them the services that they're typically contracting with 3 or 4 others with. So it gives us an ability to kind of access customers and deliver a better value proposition than those customers were experiencing from that standalone business, which, as you can tell, and I think shareholders are recognizing this, is a really, really novel way to grow at a low cost in an uncertain economic environment.
Your core verticals are restaurant, hospitality, and specialty retail. What does that mix look like right now? Is it evenly split between those three? Or is there a specific vertical where the prospects are much brighter?
So we roughly a third of our volume comes from restaurants. Another third comes from hotels. Hotels are typically larger, as you can imagine. And then we've got what we call unified commerce, which are these merchants that are trying to be everything. Yankee Stadium, a great example. We're fulfilling the ticket purchase online, and we're fulfilling all of the stadium commerce that goes on inside of that. And then it extends much further from there to merchants that want to sell all over the world. So our fastest growing vertical is this concept of unified commerce, but it encompasses a bunch of different types of merchants underneath it.
I do have to ask you, you are currently president. You're most likely going to be CEO, and that's because your current CEO at some point will effectively be confirmed and be a part of the Trump administration helping to run NASA. What is the relationship like between your company, your current management, your board, and the current White House administration?
So from a company relationship, it's really non-existent. I think the administration viewed Jared as a really natural candidate for a position running NASA. He's been an astronaut twice. He's got extensive experience inside the space community, and he's built a really successful business. So in that regard, we're thrilled to see this really tough task that he's been asked to do. I think it puts kind of some of the ambition that's lived inside of Shift4 on a grander stage. And we get to move from kind of this 26-year founder-led culture into, a public company phase with 6,000 employees and have to keep delivering on growth. I think one thing that's important to note is he will remain our largest shareholder, so he owns about 25% of the business. So we've been joking about this concept where we're losing a boss, but we're inheriting an activist shareholder. So the mission at the company doesn't really change too much.
Well, that's what I'm curious about, though, too, because, and I don't want to get too deep into politics, but we've seen just in terms of the way the president operates, sometimes being close to him is the best way to deal with them. And we've seen other CEOs who've managed to develop relationships with this administration, maybe benefit in ways that others wouldn't. And I do wonder how or if there's going to be a cultivation of that relationship.
Yeah, from my understanding, Jared actually didn't have a relationship with Donald Trump actually before this started. He's been pretty centrist politically throughout kind of his whole life and not very active politically. But I think when this phone call came, it was something he couldn't ignore. I think, aviation and space travel has been a passion for a long time, and he sees a lot of problems that can be solved, by joining and helping the fight, so to speak. So we're incredibly excited for him.
All right. Well, we really appreciate you coming in today. And, of course, a great day for you guys. Shift4 rallying about 13% in this CAS session earlier today on the back of their earnings. That is the president and the incoming CEO, Taylor Lauber.
All right, let's just recap here the earnings palooza that we got over the last 30 minutes or so. We're going to start with Starbucks. It says the turnaround of the company is still on track, even as the sales decline persists. Stock currently down about 0.4%. Snap losing ground quickly here, down 13%. First quarter adjusted EBITDA did beat analyst estimates, but it was not able to provide any kind of formal second quarter guidance. And Visa shares moving up by about 2% right now, earnings topping estimates as spending on the network stays fairly strong, and it authorized a new $30 billion share buyback program. From New York, this is Bloomberg.
President Donald Trump set to speak in Michigan in just a couple of hours, marking the first 100 days of his time in office. This as his tariff policies take shape globally, with the president signing an action to ease the impact of the auto tariffs that he had promised to impose. Joining us right now to discuss some of the changes going on in the global economy is Mariana Mazzucato. She's professor of economics at the University College of London, and she will be one of the debaters joining us this Saturday on Unresolved, Trump's first 100 days, the economic agenda from Bloomberg and Open to Debate. Mariana is also the author of several books, including The Big Con, The Entrepreneurial State, and The Value of Everything. Great to have you here.
Thank you so much for inviting me.
So I got introduced to you when Value of Everything came out, which has a lot of sort of non-economists or non-academics, if you will. But I actually want to go back to the entrepreneurial state, because you've spent a good portion of your career, of your research, kind of focusing on a lot of the elements that were in that book. There are some people that will say what Donald Trump is trying to do here in the United States, to a certain extent, is to fulfill, I guess, a lot of the dreams and a lot of the principles that you had laid out in the entrepreneurial state in your subsequent books. Do you see any parallels?
I see it exactly the opposite in terms of the agenda. So the entrepreneurial state was about how we need to actually understand the historical role that states have played when they have been part of the solution, actually helping to create what I call innovation-led growth. So in the United States, everything that makes our iPhones smart and not stupid was actually invested in by government. So the internet, GPS, touchscreen, Siri. I tell that story in the book. But what's more interesting, it wasn't just public money. These were public organizations that were mission-oriented, very capable. They were attracting top talent, and they had problems to solve. The internet came about because we needed to get the satellites to communicate. GPS came about by the Navy because they needed to know where all the ships were. So that's opposite, first of all, from the DOGE agenda, where we're just kind of, hurting and, decimating public sector capacity. We think that somehow the public sector is just there to fix the rules and get out of the way, what in economics we might call fixing market failures, whereas all those investments I just mentioned, but also the history of pharmaceuticals, the history of energy, show that actually it's always required capable, active, mission-oriented public investments, which ultimately crowd in the private sector. And when you don't have that active public investment, and where we just think that it's about, tariffs or reducing planning permissions or reducing tax, you actually don't get the business investment. And in The Value of Everything, the other book you mentioned, what I talk about is this overly financialized form of capitalism that we have in the United States, where over $7 trillion have been just spent on buying back shares to boost stock prices, stock options, and executive pay in the last 10 years. That's Trump's kind of way of thinking about capitalism.
Well, I'm glad you went there, because at least he would argue, and the folks in his administration would argue, they're actually trying to correct a system that you describe, that I think they acknowledge existed, but in their view, they think is either broken or has fundamentally run its course historically.
Interesting. So in the entrepreneurial state, I say that the U.S. has always kind of pretended it wasn't entrepreneurial. So I jokingly say that we talk Jefferson, but then act Hamilton. Hamilton, everyone now knows who he is because of the musical, but he was someone who believed actually in that active role of the state. And what's interesting is that Biden was actually one of the presidents that, for the first time after many decades, brought back what I would call ambitious industrial strategy. So, the CHIPS Act, for example, $300 billion to try to make the U.S. sovereign in chips production because we are over-reliant on Asia. What was so interesting in that act is it wasn't just a giveaway. It wasn't just a handout. They put some conditionality in it that required, for example, those companies benefiting, semiconductor companies, to reinvest profits, to treat workers better, so improve working conditions, and to use energy-efficient supply chains. So Trump has gotten rid of, or he says he's going to get rid of, the CHIPS Act. Now, tariffs only make sense with Trump's own reasoning to increase and boost U.S. competitiveness if they are protecting strategic industries. Hamilton would have called it an infant industry argument. Strategic industries to allow them time to develop competence. But that means, A, it's not blanket tariffs. They have to be strategic, whether it's in chips, whether it's in energy, whatever. And second, they have to be accompanied by an active industrial strategy to help those companies actually achieve competitiveness. He's not doing that. He's simply introducing, A, blanket tariffs, not strategic tariffs, and second, not really having, at least he hasn't talked about it, maybe it's there, I haven't heard it, an industrial strategy. And I'll tell you something funny. In 2019, I was invited by Marco Rubio's team. I pronounce him as though he's Italian. Marco Rubio, I'm Italian. And he had read all my books, like you did, thank you very much, and even wrote 2 reports, which have now been taken down apparently from the web. One was on China, and he basically argued we will lose against China because we don't have an industrial strategy. We don't have what he called an entrepreneurial state, and he cited that book. And then another book on the U.S. middle class, who he said was getting hurt by having corporate governance structures, which, as I said, were not reinvesting profits. So I actually think the Trump administration, at least in individuals like Rubio, know that you can't just have mercantilistic policies about building walls, about trade regimes. It has to be about that capacity building, but we're not hearing it.
So going to that ambitious industrial strategy that you talk about, you also talk about a purpose-driven industrial policy, and I'm curious what that looks like and how you do that without incurring a huge amount of debt, because that's another thing that the U.S. contends with and that bondholders in other countries are very mindful of.
Right. So, I think there's a huge confusion, and I wish I could just do an Econ 101 class on Bloomberg one day for all your viewers. First of all, you might remember that X over 0 in basic math classes is what? Infinity. Right? So if you have debt over GDP, if you are not actually investing in all the things that are long-run drivers of the denominator, GDP, you can actually reduce your debt, but the ratio might increase. That's what we've seen in many countries, like in Europe, when we had austerity, which was just cuts. So it decreased the debt, it decreased the deficit, but it also decreased much quicker the long-term GDP growth, so debt to GDP rose. Now, to do anything, whether it's net zero, whether it's healthy populations, whether it's preserving, our biodiversity, whether it's reducing the digital divide, we need that public investment. If it's done in a smart way, it will expand productive capacity. Right? So it won't actually cause inflation. Inflation can happen when the government's just spending money and not kind of strategically, so it doesn't expand productive capacity. And if that increase in debt in the short term to make those investments isn't then driving that long-term growth, if it's not catalyzing business investment, because that's what we need, business investment, then of course it will be bad. But that's just badly designed public policy. So what I call mission-oriented policies is focus on goals, just like going to the moon, and then get lots of different sectors to work together to drive that. So going to the moon wasn't just aerospace, it was just as much changes in nutrition, materials, electronics, software, and they had outcomes-oriented procurement policy. There was 400,000 people involved, most of them in the private sector, but with the lead role of the public sector. We got software, baby formula, camera phones out of that because we were solving problems.
Sure. Well, you talk about government playing this leading role. What about higher education? Ideally, what is the university system's role in fostering the innovation that you speak of? Because right now, the current administration seems pretty intent on reducing higher education's role.
Right. Well, that will definitely, I don't think there's any debate about this, at least from any economist that I know, that will hurt U.S. competitiveness. We know that whether it's in life sciences, nanotechnology, clean technology, space technology, we've required so much basic research, but also applied research done in universities, often funded, whether through NIH grants or NSF grants. But those universities are also, by the way, in the humanities, thinking big. What kind of society do we even want to live in? And universities are about debate. It's not about having a cult just thinking in a left-wing way or a right-wing way. And we need that open debate that universities have always, for the last, 3,000 years, been central for. So it's a huge damage to, I would say, what Aristotle would call the polis, the community, to close down the debate by, telling universities what they should be doing.
Speaking of that community, and just going back to just the global economy, are we looking at a future where there is going to be effectively a global community, at least to the extent that we saw it out of the post-World War era? This seems to be being torn down. In some cases, some people think it's being torn down deliberately. Yeah. And I do wonder what fills that vacuum. Is it something new, like a different type of unity, or is it going to be much more of this sort of unilateral, bilateral type of economic world?
Well, I've just come today from the United Nations where I was giving some talks, and luckily there's enough leaders out there who still believe that there's global goals. There's those 17 Sustainable Development Goals that can actually drive innovation, drive investment if we take them seriously. And there was recently an op-ed which I found inspirational by 3 leaders, and it was the president of Brazil, Lula, the president of Spain, Sanchez, and the president of South Africa, Ramaphosa. And the good thing is they're all actually leading big global debates this year. So there's the COP meeting in Brazil, there's the G20 meeting in South Africa, and there's this meeting in Seville on financing for development. So these 3 leaders are what I think is the coalition of the willing, but there's many others out there. And what they're basically saying is, it would be great to have the U.S. with us, but these problems are too big to give up just because one country is giving up. And you know what? They're going to have to catch up later. So come back later when you've grown up.
I am curious, though. I mean, of those three countries, I mean, South Africa kind of stands out, but not necessarily in a good way, at least in my view. And I saw that you were recently appointed, that Ramaphosa basically appointed you to the G20 there. I mean, what is attractive to you about that economy, and more importantly, about the potential policies coming out of Ramaphosa and how it moves the economy?
Sure. So first of all, that position is a pro bono position. I'm an advisor. Academics like to try to help leaders steer in the right direction. And what attracted me, first of all, is that this is a country with huge problems. I come from Italy. We have huge problems. We have problematic states, right? I'm not there to defend the public sector. We have many problems within public institutions. And that's why we do need to look at inside those organizational reforms. But what's interesting, at least, it's all opinions, but I believe that the president of South Africa is serious when he's really asking himself, what does it mean to all of a sudden really get serious about directing growth? It's not just growth for growth's sake, it's growth that has to be inclusive and sustainable. What does that mean in South Africa, for example, of rethinking even things like state-owned enterprises? Their very large state-owned company called Eskom has had large problems. What does that mean as a new relationship between public and public, right? Because that's actually a different form of public. What does it mean for procurement? They're thinking a lot about those kind of tools, whether it's digital governance or procurement, in order to drive the economy, in fact, to reduce inequality, which unfortunately remains very, very high there. But what's interesting is that when these kind of countries also then host a global agenda, they should actually be walking the talk, right? So show what you're trying to do and show that it's hard, but then have a global conversation. Like Lula himself in Brazil, what was so interesting was that they put the ecological transition at the center of finance. It wasn't far away in the Department of the Environment. So that meant, what does it mean for BNDES, their public bank? So what I'm interested in is not the big ideological questions, good or bad government, good or bad business, but what does it mean to look inside and to do what NASA did after the famous NASA Apollo 1 fire, where those 3 astronauts died, and one of them, Gus Grissom, yelled, how the bleep are we ever going to get to the moon if we can't even talk between 2 or 3 buildings? Because they couldn't hear what was being said from Mission Control Room. So NASA changed its bureaucracy based on that. We're not changing our bureaucracies. We have old, vertical, inertial bureaucracies. But that doesn't mean we should just cut the public sector. We need to redesign it. We need gov labs. In Chile, for example, again, I'm coming from the UN where I'm hearing all these examples globally. In Chile, they have Laboratorio de Gobierno. It's a lab within government to experiment, to actually reward experimentation. Venture capitalists are always bragging about, for every success they needed to fail 7 or 8 times, that learning by doing trial and error, producing a learning economy within our governments is what the conversation should be about, not the Doge just chainsaw everything.
Well, what you're talking about doesn't invite instant gratification, whereas Doge might for some people. Thank you so much. Really appreciate your joining us today. Mariana Mazzucato is professor of economics at UCL, and she is author of Mission Economy. And reminder to not forget to tune in this Saturday to Unresolved, Trump's first 100 days, the economic agenda from Bloomberg and open to debate. This is The Close. Breaking news, we have shares of Supermicro plunging in after-hours trading after the company pre-announced results that fell short of analyst estimates. This is the server maker, and it's a sign that perhaps the comeback plan is not really gaining traction. Bringing us more is Bloomberg's Tom Giles. And Tom, we're seeing NVIDIA shares decline on the back of this Supermicro pre-announcement. Tell us what the read-through is.
Yeah, the concern here, and Supermicro outlined it in a preliminary statement saying that, some customers are delaying orders. That's raising concern about whether this server maker, which had this huge run-up last year, you'll remember, around the surge in demand for all things data center, all things generative AI. They really benefited from that in the late part of 2023, early part of 2024. You saw a huge run-up in shares, and then things started to lose steam in the latter part of last year. There were concerns about reporting. There was a Hindenburg research report. There were concerns about just how they're reporting and delays in some of their quarterly reports. They issued a statement late last year saying that there was no wrongdoing found, but they needed more time. So there's just been lots of questions around this company that for a hot second was a real darling of the AI boom. And, if they're seeing orders being delayed, and presumably this is regarding the geopolitical, the trade tariffs, et cetera.
Right.
If they're seeing delayed orders, maybe NVIDIA is too. That's the speculation.
And this also gets to this idea too, Tom, and there's been so much speculation about some of the news that we've learned out of Microsoft potentially scaling back some of its data center build out. We've heard from a couple of the hyperscalers as well. Are those dots that can be connected?
Yeah, there has been some questions about whether Microsoft and some of the other hyperscalers are scaling back their data center plans. You remember there's been this huge buildup. There's been all this talk, all these pledges to spend billions and billions of dollars on data centers here, in the Middle East, all around the world to meet demand for the computing power, the massive computing power that's needed to generate large language models and to keep them running, to feed them, and to really kind of keep this generative AI boom in play. The concern is, have we gotten ahead of ourselves, and do we need to spend all that much money on these data centers? Microsoft, the Microsoft spending plans, it's been really hard to tell exactly what that's about.
Yeah.
Is that just kind of, rebalancing the portfolio, or are they really starting to question whether this much spending is necessary? And remember, DeepSeek got us all asking that question back at the end of last year.
Yeah, and hopefully maybe we'll get some answers to those questions later this week. Of course, Meta, Microsoft set to report tomorrow, as is Qualcomm, Amazon on Thursday. Tom Giles, our man out there in San Francisco, Supermicro right now, the biggest decliner in the after-hours trade. We do want to turn from what's going on in the markets to, let's turn to what's going on in the economy. There's a lot of economic data on the way as investors seek clarity on the global trade fallout from tariff uncertainty. Tomorrow morning, we get first quarter GDP numbers. We also get those PCE numbers for March. And it's raising a lot of questions here about how the C-suite will react. Olaolu Aganga is U.S. Chief Investment Officer over at Mercer, which just published its 2025 Large Asset Owner Barometer. It's a report with insights from asset owners with a collective $2 trillion in assets under ownership. All right, this had to have been a big undertaking, and I assume compared to other years, this had to be a much different report. What was the main takeaway? Do they feel scared? Do they feel vulnerable right now based on what they're seeing with regards to economic conditions?
So we issue this report every year. It is a big undertaking, 16 countries, large number of assets, different client profiles. And we do this to be able to get a sense of trends, right? So the annual change year over year is a pretty big deal. There are a couple of meaningful takeaways. So the uncertainty impact is across the board. Doesn't matter what type of client you are. Yes, it's a very uncertain environment. These asset owners can move markets, can set trends. We are seeing a stronger preference for private credit, which is a shorter lifespan in terms of private markets, like private equity, you call it 10, 12 years. So this one is shorter lifespan. So there's more preference for illiquidity. A lot more concern about the U.S. and U.S. assets. Now, not a move. We're not necessarily seeing selling and migration, but a little bit more of a pause.
A little bit more of a pause. Has there been any sense when doing this study that there would be a meaningful shift in capital to non-U.S. assets, non-U.S. markets, if things really did get worse?
We would have to see that play that out in the data for a bit for these institutions to be able to move, and frankly, I would say broader institutions to move. The U.S. and public market space is 60-70% of the equity market. Seeing the same in terms of private markets and private equity. The companies, the investment opportunities are here. The backdrop is more difficult, but the investment opportunities are here. So we'll see how that sustained backdrop plays out.
How much of the Sell America trade that we saw really take off in April is visible in some of the comments that the large asset owners were able to provide?
For us, for the large asset owners, for the most part, a lot of this is diversified equity portfolios, diversified portfolios in general, right? So American exceptionalism is not a founding principle of investing. They do have a good amount of U.S. assets. We have seen some move on the margin, so treasuries, that's more recent, not necessarily the survey data that we've seen. But for now, it is somewhat stable. So there's a bit of a pause before a decision, is made within an organization to make that type of a shift.
And just to understand, how overweight were these large asset owners in U.S. assets, whether it's equities or treasuries, just to get an understanding of how big that American exceptionalism trade really was?
It wouldn't be known by absolute percentages. They did have large holdings of U.S. assets, but that does make sense if you look at the size of the market and the opportunity set and how much is in the U.S. anyway. What was happening over time is the size of the U.S. has just been growing. It's been growing in indices. It's been growing in broader holdings. So by default, you're seeing organizations across the board holding more U.S. assets. Again, recent trend right now is not the best for U.S., but we've always advocated for diversified portfolios, and you see that in their holdings as well.
I am curious, though. I mean, we kind of teased this with this GDP report coming tomorrow, and this is kind of the first real look at the economy under the leadership of the current administration. Most people are expecting to see contraction for the first quarter. Are there big regional differences, meaning U.S. versus Europe versus Asia, Latin America, et cetera, and how people are viewing the economy this year and where it would go?
The overwhelming view on the U.S. and ourselves as well is we're seeing unemployment rise. We will see unemployment rise. We've seen that on a federal level. We're going to see that on a corporate level. You're seeing fiscal tightening. You're seeing corporates and all of these earnings announcements talking about the backdrop. These are U.S. companies. So the macro backdrop for the U.S. is more challenged than some of the others. If you overlay that with valuations, so U.S. equity valuations were at multi-year highs. We've seen drawdowns for sure, but we're still not at a level that the markets are cheap. So if you were to look at the backdrop, the GDP data, the contraction is expected. Actually, the signs point that it could get worse. It could get worse if that continues.
There's the economic growth part of the equation. There's also concerns about the potential reigniting of inflation because of the tariffs and other policies as well. What did that show? How did that show up in the report?
The inflationary aspect of the market meant that overall there was some caution and actually a little bit of a pullback in public markets. So as these large asset owners were looking to invest, allocate capital, the higher inflationary environment, the higher rate environment meant that they had more cash flowing type of assets. There was a higher allocation to private credit, which is a spread product. But then at the same time, there was a preference for infrastructure. So that was another notable shift that we saw on a year-over-year basis. So some of the more uncorrelated assets, some of those assets that do well in this type of an environment, we saw a meaningful pickup year-over-year.
In the report, you say a significant proportion of participants are either seeking to increase or decrease their allocations over the next 12 months. In terms of volume of activity and frequency of activity, do they anticipate being much more active over the next 12 months because of the uncertainty, or less active?
Less active. When there is big drawdowns and uncertainty, the first thing is no knee-jerk reactions. You have to go through a very thoughtful framework. And as you see, trillions of dollars of assets. So when they move markets. They can affect, a large swath of the investable universe. So as a result of that, it has to be very, very deliberate. So you do a lot of work. You watch the trends. You're following the data. You're looking at capital flows. And then when you move, you will see some sort of a meaningful impact. But it tends to sometimes be, gradual. We're seeing that again in some of the flows in treasuries. Could be a few months. It depends on what happens, actually.
Olaolu, great to have you, and I'd be curious to see what this report looks like in a year's time. But a great report, annual report of the world's largest asset owners, Olaolu Aganga, Mercer's U.S. Chief Investment Officer here. As we wrap up the show here on this Tuesday afternoon, Scarlett, and a push ahead to what could be a really consequential 24 hours. Overnight, we start out in China, some economic data dropping.
Yeah, PMIs coming out of China, but let's get to earnings for the following day because we've got Meta, Microsoft, Qualcomm, eBay. Of course, we'll be breaking all of that for you on the close tomorrow.
And then we're also going to get big economic data here in the U.S., including the first look at first quarter GDP as well as monthly PCE price index as well. And then, of course, we're all watching the President of the United States marking the 100th day of his second term. And apparently that's being marked tonight.
Yeah, he's doing it on the 99th day. And of course, there's going to be a special extended edition of Balanced Power today. Trump is set to speak in Michigan in just a bit.